The number that splits a bargain from a trap hides on a single page. Your report never prints. Two chocolate makers post the very same $2 profit. Same price, same story, same clean face. One of them quietly bleeds cash behind an identical, spotless ledger. The line that tells them apart never appears on any printed page. Companies hand you one capital spending figure and refuse to split it. Buffett splits that figure on pure instinct. He acts before a single dollar of his moves. You almost bought a value trap that wiped out its last 3 owners. Real investors lost $200,000 apiece here and never recovered. Get it wrong and a value trap hides in plain sight. That quiet trap can leave you broke. Today you compute that hidden number yourself on Hershey's real ledger. The habit that separates the pros is simple. They build the fact before the money leaves. By the end, you hold a tool Wall Street desks quietly skip. Every business spends money on 2 completely different jobs at once. Some cash merely replaces what already exists. The tired machines and trucks that wear out and die. The rest builds new capacity the company never owned before. Accountants pour both streams into one bucket on the ledger. Maintenance capex keeps this year's earning power flat as a dead chart. Growth capex reaches for a bigger earning power next year. Maintenance is repaving the cracked lot and rebuilding the worn ovens. Maintenance is the aging fleet of 40 trucks you replace on schedule. Growth is the second bakery rising next door, a whole new plant on the empty gold lot. Growth is the new line bolted into the dark plant, the line that doubles what the plant can ship. One keeps the engine idling, the other bolts on a second engine. The cash flow page shows you only the total sum. It hides the mix that can quietly ruin you. The mix that it hides is where quiet fortunes crash and vanish. $1 of growth capex is entirely optional. Even Buffett calls that spending a free choice. $1 of maintenance capex is a bill you can never refuse. Beginners make the mistake that ruined fortunes and wiped out savings. Confuse the two and you badly overpay. Or you buy a company that quietly goes broke. Value investors care because the wrong bucket bankrupts the careless. Cheapness on a bright screen is only a story. Maintenance capex is the cold, hard fact, so we drag that fact out of the numbers hiding on the page. Buffett measures a business by something he named owner earnings. Owner earnings are profit plus depreciation minus real maintenance capex. Read that formula again. It says maintenance and never says total. The trap that fools Wall Street subtracts total capex and goes broke. Do that to a fast grower and its cash suddenly looks broke. You punish the firm for its best growth, then it goes bankrupt. Deduct it as upkeep and you slowly go broke. So a wonderful compounder looks wildly overpriced on your red screen. The second error runs the other way and has destroyed real fortunes. Lazy analysts assume maintenance equals depreciation, then go bankrupt. Depreciation is an old accounting guess, not this year's repair bill. Bruce Greenwald warned of the gap that inflation secretly widened. When steel and machines cost more, upkeep quietly outruns depreciation. Assume they match and you overstate the cash a fading business bleeds. The bargain that looks safe on the page is often quietly starving. You could buy it cheap and watch the whole stake go worthless. Both mistakes share a single cure. Estimate maintenance capex directly. Bruce Greenwald built the method that finally dragged that number into daylight. His method needs only the numbers every company already prints. We run the method on Hershey right now. Clean round numbers straight off the page. Gross property and plant sits right there on the balance sheet. Use gross before depreciation, so old machines still count fully. Sales sit at the very top of the income chart. Every figure we need already sits in Hershey's public ledger. Step 1 asks how much plant each $1 of sales demands. Take the gross plant figure, then divide it by yearly sales. Average that ratio across 5 full years. That smooths the lumpy, uneven years out. Say Hershey carries 50 cents of plant for every sales dollar. The ratio that results prices every new $1 of revenue. Step 2 measures how much the sales actually grew this year. Here is why that ratio matters so much. Say sales climbed from $2 billion to $2.2 billion. That jump is $200 million of brand new revenue on the page. Step 3 turns that growth into the capital it quietly demanded. Multiply $200 million by the 50-cent plant ratio. Growth capex lands at $100 million this year. That $100 million bought a bigger tomorrow, not today's survival. Now open the cash flow page and read the total capex line. Say Hershey reports $180 million of total capex. Step 4 is one subtraction and it reveals the hidden truth. Total capex minus growth capex leaves the maintenance capex standing. So $180 million minus $100 million leaves $80 million. The upkeep that Hershey cannot dodge costs just $80 million a year. The other $100 million was pure growth Buffett would never deduct. Now watch what that one number does to the whole valuation. Say profit plus depreciation together give $260 million on the page. The lazy method subtracts the entire 180 million Oz. It makes a healthy grower look flat broke. Greenwald keeps only 80 million and reports $180 million instead. The correct number is more than double the careless one. Same company, same year, either richly priced or a screaming bargain. The verdict that swung by 100 million rode on one quiet choice. Notice how nothing moved but the capex you chose to believe. Growth capex is never the cost of merely staying alive. It is a voluntary $100 million bet on a larger future. Punish it as upkeep and you bury a healthy compounder alive. The grower that you buried springs back the moment you split the capex, but now run the same method backward on a dying mill's ledger. Picture a mill whose sales bleed a little lower each year. Its looms are ancient and their soaring upkeep slowly bankrupts it. Depreciation on the books reads a comfortable $50 million, but real upkeep this year bleeds $80 million in hard cash. The trap that snares veterans hides in that $30 million gap. Assume maintenance equals depreciation, invent $30 million and go broke. The dying mill now poses as a cash-rich bargain on the page. You buy it cheap, feeling rather clever. One lazy shortcut quietly wiped out your stake. Each year the real repair bill bleeds, the dividend deep red. Quarter after quarter the cash never comes and owners go broke. Patient owners lost everything to one shortcut. That single shortcut cost them the whole fortune. They trusted depreciation instead of upkeep, and it left them broke. The bargain that never worked simply bleeds red from day one. Its true owner earnings were worthless, deep in the red all along. Only a direct maintenance estimate saves you here. It flags the hidden rot on the ledger early. Compute maintenance capex directly, and the trap reveals its own flaw. Growth capex misread, as maintenance makes cheap stocks look dear in red. Depreciation misread, as maintenance makes real traps look safe, then bankrupts you. Bruce Greenwald's students dodged the trap that ruined everyone else. So keep the 4 steps where your instinct can grab them fast. First, gross plant divided by sales, averaged across 5 years. Second, this year's sales growth, say $200 million in hard dollars. Third, growth times the ratio gives the money spent to expand. Fourth, total capex minus that leaves the upkeep you cannot dodge. Owner earnings rest on that one maintenance number. Read it off the page. Never total capex. Do this and a grower stops looking falsely overpriced in red. Do this and a business that would go bankrupt stops looking safe. The report hands you a single capex figure. You now compute 2 right on the page. The edge that Buffett and Greenwald kept for decades is now yours. If this handed you a real usable tool, subscribe. Keep this daily value series close. We forge one usable value skill on this channel every single day. Next, the punch card with 20 slots that would make you rich.